and market memories are such that that can't be good. Let's go to Kenny Polcari on this. We also have Larry Glazer on this, two market pros. Kenny, to you first on what investors are hoping for more. They don't like the Faustian choice. They don't like inflation, but they don't like a recession if the Fed goes too far tackling inflation. What wins out in the end?
You know, I'm actually not so sure that they're not hoping for a recession, just not a deep one, right? If it's mild and it kind of takes some of the fluff out and brings inflation down, that might be the best choice out of them all. The problem is going to be, I don't think, and I think the market is starting to tell you that they don't believe the Fed is in a position where they can navigate that soft landing. I think it's going to be a hard landing. I think it's going to be, and with every day it grows a little bit harder. And I think that's why you continue to see this volatility. Yesterday's 602% rally was really mind-boggling because nothing has really changed. Rates are still going higher. Inflation is still out of control. And so there's certainly a lot of confusion. I don't think Powell's comments today, I think they continue to be confusing. On the one hand, he says, you know, it's all good, we're okay. But on the other hand, he says rates are still going up and we're going to still watch the news and there may be some surprises. And I also think they're getting ready to put out in the narrative one more time of a possible 100 basis point increase in July. I think they've started laying that groundwork yesterday. Harkin started saying it today. Barkin started saying it today. They're putting it out there so the market becomes comfortable with the potential of a 100 basis point move in July.
Wow. You know, Larry, I mean, there was even talk of that at the last meeting that we might see a full percentage point hike, which was routine under Paul Volcker. Right. Of course, that was then the argument that it's going to be very hard to pull something big like that. But what do you make of the possibility that they could be setting the stage for that?
You know, Neil, the markets really don't like surprises. I would almost use the word they hate surprises. And that's one of the reasons we've seen so much volatility. The worst first start to the year since 1970. Last week was one of the worst weeks we've seen in years. So all of that is pricing in the fact that the bar is coming way down on the economy. People are getting concerned. Recession word is everywhere, right? But you know, the Fed has a credibility problem, as Kenny mentions here, and they're trying to restore that credibility by recognizing that they hit this inflation issue hard. Finally, took them a long time, and by doing so, they may actually start to catch up on the problem. They're not ahead of it. They're still behind, but they are catching up. So all those Fed officials are out there sort of laying the groundwork so we won't have future surprises about the Fed having to raise rates to address this issue. The real concern is, as Kenny mentioned, is it priced in? And a shallow recession, definitely getting priced in. A slowdown in the housing market, definitely getting priced in. A slowdown in the job market, all those things getting priced in. If it's worse than a mild recession, it's probably not priced in. And I think that's the question we all have to ask ourselves is the Fed actually making progress in this issue, or are they just completely out to lunch?
You know, Kenny, on that point, maybe we're seeing the fear that, you know, this takes hold of the economy, all these rate hikes, and even though Powell has been very forceful in saying the underlying economy is strong, job growth is very, very strong, not like it was in the 70s. He didn't add that, I did. And then that avoids this talk or threat of a recession. But the backdrop is not necessarily positive, right? Pulte Group today, the big home builder, downgraded by RBC on early indications and early innings of a housing downturn. It's affecting all the home builders as a result. What do you make of that?
Look what J.P. Morgan did today. They just laid off a bunch of mortgage brokers in what they suspect is going to be a very slowdown in the mortgage market. And that makes sense as the cost of money goes up. Look, from when rates went from 3% to 6%, there's now 18 million households that no longer qualify for a $400,000 mortgage because the money's too expensive and they can't afford it. That's a 36% reduction in demand. And rates haven't really even started to move yet, right? We're only still at 1.75% after June's rise. If they rise by another 75 or a full percentage point, think about what's going to happen to mortgage rates then, and then think about what's going to happen to the housing market. I'm not trying to paint this, light your hair on fire scenario, but people have to understand we've been in this for 12 years. They've been stimulating for 12 years. They've been overstimulating for the last 3. And now to get out of this is going to be, it's not going to be smooth by any stretch of the imagination.
Guys, I want to thank you. One of the reasons hang on to that thought, my friend. I'm not meaning to be rude and